Hello, everybody. Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation, bringing you another subscriber request series, Lessons in Valuation 2-minute drill. Today's company is going to be Estee Lauder. Now, remember, these are high-level videos and are just a quick cursory look at the companies to help you decide whether you want to invest more time and energy researching the stocks or not. So let's analyze what we see on the history of the company. I'm going back all the way to 2005, and it has a June fiscal year, by the way. We see that the company has quite a bit of cyclicality followed by spurts of growth. Earnings were down during the '08 recession, but they strung together about 5 or 6 years of really good earnings. Then they were down 10% in the June 15th period, followed again by another surge. And then they had a pretty big drop during the COVID crisis where earnings fell 24%, but then they followed that up with 2 strong years. And then what I want you to notice, for the last 3 years in a row, the company has seen earnings collapse by rather substantial amounts. So much so that their dividend has already been cut, and it's not the first time they've cut it. Their payout ratio is actually above 100% right now. Okay, and that to me is a red flag for a dividend-paying stock. It is an A- rated company, but now when I put weekly closing prices on the graph, a couple of things become just extremely evident. Number one is, while it was trading and following its normal earnings justified level of around 15 times earnings, it got pretty highly priced in 2010, 14, and then it went crazy and the stock got really high where the PE ratio got up to over 55. And of course, once earnings began to collapse, that led to a collapse. So the normal PE for the long period of time is 29. If I shorten the time frame, the normal PE has been as much as 40. But I really don't think it was ever justified. It only has an earnings yield today of 2.44%. That means if they paid you all the earnings of the company, you'd only get 2.44%. And that's very similar to the dividend yield, obviously. In other words, they are paying out over 100% of their earnings right now. Looking forward, analysts do expect the company to recover. So if you're interested in a recovery play, this could be one that's interesting, but I think it's even expensive on that basis. But Estee Lauder was founded in 1946. It's a high-end skincare, makeup, fragrance, and hair products. With FastGraphs, you can always go into the company's website if you don't know the company and look up what the company does and who they are, etc. But anyway, this has been a subscriber request to look at Estee Lauder. I personally think it's maybe a turnaround play right now, but I don't think it's fundamentally sound. I've been examining reasons why the earnings have been so poor the last several years. Anyways, hope you enjoyed the video. If you did, give me a like, ring the bell so you can see future videos, and take a look at subscribing to FastGraphs. I call it the value investor's best friend for good reason. It really can help you make better decisions or even decide whether you should waste your time researching a stock. Thanks for watching.